Hey guys, welcome to another episode. In this video, we will show you the best technique to combine multiple time frames to get a well-informed and clear chart analysis. By combining price action and smart money concepts, we will demonstrate how to effectively make a top-down analysis to identify the market direction, supply and demand levels, liquidity zones, and trading opportunities from higher time frames to lower details. So guys, if this is something that interests you, please hit the like button to show your support and subscribe if you're new. See you guys after the intro. So, what is top-down analysis? Top-down analysis is a technique that combines the analysis of multiple time frames and market factors to gain a comprehensive understanding of market conditions. Starting from higher time frames and zooming into lower details allows us to get a major view of market direction in key areas at all levels. But remember, starting from the monthly time frame applying every single concept out there will make your chart look like this when you reach your entry time frame, which is completely useless. This video will teach you what to exactly look for in each of the time frames to make a well-educated analysis of any chart easily. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1. Overcoming directional confusion. Here on the pound-dollar 5 minutes chart, the market looks choppy without any visible direction. It continuously violates the structure levels to both up and down sides, confusing any trader trying to identify the direction. But if we zoom out to the 1 hour's time frame, you can quickly identify the market trend and the bearish pressure. This area is the same area on the 5 minutes chart we were previously observing. So, by knowing the higher time frame directional bias, we can take short entries with confidence in the 5 minutes chart. Remember that whenever you are confused about the direction and the market keeps violating key levels of structure, you are focusing on the wrong time frame. So analyzing the bigger picture helps you to enhance your ability to take more precise and confident entries. Number 2. Increasing accuracy. A minor reaction to a higher time frame key level can be a significant trend change in the lower time frames. So before placing any trade, we should check how much room we have before tapping into a higher time frame supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. Here on the Euro-Dollar 15-minute chart, we had a strong bullish move with a clear fair value gap between the shadows. As a result, we have a valid order block, which is an excellent opportunity to go long. However, the market suddenly changes direction and ignores the demand order block, and in case you are wondering, here is why. If we zoom out to the 1 hour time frame, we can see that this change in direction could be due to reaching a higher time frame key level that acted as strong resistance multiple times previously. So checking the higher time frame key levels could help us avoid this kind of unnecessary risks. On the contrary, look at another example. Here in the 1 hour's time frame, we have a move with obvious inefficiency breaking above the previous market structure. So here, if the price manages to pull back to the order block zone, it would be a perfect opportunity to enter a long position, set our stop below the swing low, and target the next level of market structure in front of the price. So let's see what do we have on the higher time frame. Here on the 4 hours, we can see that we have recently broken above these supply areas, so demand is in control, and we have enough room to go before reaching the next unmitigated supply area in front of the price. So could be a perfect trade since we have combined higher time frame levels and directional bias with a lower time frame entry setup. Number 3. Optimizing trade entries. Analyzing multiple time frames allows traders to identify optimal trade entry and exit points. For instance, imagine if you were waiting for the price to pull back to the order flow area and open buys to go along with the bullish momentum. If we set buy orders at the beginning of the zone, our stop will be too large. So an optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps to get in the trades at a better price, reduces the likelihood of false signals, and increases the trader's confidence in their analysis. Now that we have discussed the importance of a multi-time frame analysis, let me show you the best technique to combine multiple time frames to get a well-informed and clear chart analysis. But before we continue, if you have enjoyed this video so far, please smash the like button to show your support and comment below if you have any questions. Now let me show you our top-down analysis technique, step by step, which is the process of going through a higher time frame and scaling down to the lower details to identify best trading opportunities. We consider 3 types of time frames in our chart analysis. Starting from higher time frames, first we have weekly and daily, which we only use to identify higher time frame key levels of the market structure. Second, we use 4 hours and 1 hour time frame to do most of the analysis, including identifying market direction, supply and demand areas, order blocks, liquidity zones, and trading opportunities. Third, we use 15 minutes and 5 minutes time frames if we needed more confirmations and entry reasons in lower details. Now let's apply these concepts on the real chart of multiple pairs to completely understand this technique. Here we have euro-dollar on the weekly time frame. In the first step, we mark the key levels of market structure that price have recently reacted to. We want to keep our analysis simple, so we only draw the most recent levels near the current price. For example, this level is our historical top, which has recently rejected the price twice. We have another key level in front of the price, which has acted as support multiple times. Also, we could draw another key level here. Now, this is the only thing we need from the weekly time frame, which is the key levels of market structure that have a high chance for price to react to when it taps into them. So, let's zoom into the daily. On the daily time frame first, we adjust the weekly levels to get the greatest number of touches from the daily perspective. Second, we draw the daily key levels of the market structure with another color. The reason is that we want to be able to distinguish the weekly and daily levels when we zoom into the lower time frame, since the higher the time frame, the greater the importance of a level. Now this was also the only thing we needed from the daily time frame. But remember, you need to keep 3 things in mind when drawing levels of market structure. First, draw the levels where you could get the greatest number of touches. Second, drawing from the bodies of the candles has a higher priority. Third, treat the levels as areas, not solid lines. Also, there are 5 criteria that we look for when identifying key levels of market structure, and each one of them makes a level more powerful. Number 1. The turning points. Turning points are the areas that have reversed the market trend previously. The market sees these areas as overvalued or oversold, and there is a higher chance for the price to react to these levels when it reaches them again. Number 2. Multiple rejections. Multiple rejections from an area show that traders took action at